Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about the four basic building blocks for all option trades. It's buying and selling puts and calls. That's it. But it's a big hump to get over when you're first learning about options. So I redo this video every so often. Last time was about 3 years ago, and I'm going to do all this on the Fidelity platform. Maybe you trade there as well, but you can definitely take this information to another brokerage as well. So it can be in depth, and it's going to be pretty long, and there's going to be lots of chapters down below for you to pick from. So you don't have to listen to me blab for too long. You can jump to one of those chapters and maybe get the information that you're looking for. So I'm going to focus on making sure that that's pretty tight. But overall, I get it. There's a lot of fear when you first get into options, pushing the wrong button and losing a bunch of money. So that's what this video is all about. Also, if you get any benefit from this, please like and subscribe. And with that said, let's get started and talk about basic options. Whoop. So this video is all about the four basic building blocks that you need to understand when it comes to trading options. That is buying and selling puts and calls. And we're going to do this with the Fidelity trading platform, but you can take this information to any brokerage and apply it. Once you understand this, you'll be well on your way to building out the fanciest trade you can imagine. But we want to understand these basics first. So with Fidelity, you're going to have to open up an account, as you see here, and apply for Tier 1, Tier 2, or Tier 3 option trading privileges. And this is here to protect us, right? We don't want to go into something like this and not know what we're doing and click the wrong button and lose a bunch of money. So they have Tier 1, Tier 2, and Tier 3, as you can see here. If you're just getting started, Tier 1 is going to be fine. For what we're talking about today, everything is covered under Tier 1. So buying shares and then selling a covered call, that's in Tier 1. Buying calls and puts, that's in Tier 1. Selling cash covered puts, that's in Tier 1. So those are the four basic ones that we're going to talk about today as we work through this. So that should work out fine. As you get more comfortable trading options, you can ask to go to Tier 2 or Tier 3. But it's a great place to start and should cover just about everything you need when you're getting started with options. So I did put together a little cheat sheet here for each of our four trades, and my game plan here is to review each one here, then go over to Fidelity, set up a trade, talk through that, and then at the end of this, I'll have some example trades where we actually do the trade, click the button, buy, sell, that kind of thing, so you can see how it all fits together in the end. And again, I'll outline all this with chapters down below, so if you want to jump to a certain type of trade and review that, you can do that. So we're going to work in a clockwise fashion because that makes sense. So we're going to talk about buying a call option, then buying a put option, then selling a put option, and then selling a call option. And those are our four building blocks. So let's start up here. Let's zoom in a little bit. Let's talk about buying a call option. So every option contract is an exchange. There's a buyer and a seller. And in this case, we are buying a call option. And with every option contract, there is an action. And in this case, since we are a buyer, we are buying to open a position. In our account, it's going to say we own one contract. Where the person taking the opposite side of this trade is the seller, they will say they are short one call option. It'll say -1 in their account. Ours will say +1 or just 1. Now, in order to do this, we have to pay a premium. All right, so we're paying a premium to the person that's selling this contract. Now, why is that fair? Well, it's fair because when we pay this little bit, we are paying a fraction of what it would be to control 100 shares. So you have a choice here, right? You can pay so much to buy 100 shares of the underlying, or you can pay a fraction of that and control 100 shares with a call option. So we're using leverage. We're paying a little bit to control 100 shares. Now there's a concept with this that comes along with options, and that is in the money and out of the money. So I kind of have that spelled out here. In the money gives you better odds if you're buying a call option, but it's more expensive. If you do out of the money, that's lower odds, but it's less expensive. So what does that mean? Well, when we're buying a call option, I always like to use the example, and you'll hear this with options a lot. Stock XYZ right now is trading for $100 a share. If you wanted to buy a call option that was out of the money, meaning it had no real value, it would be above that price. So if we bought the 105 call option, then that would be out of the money. It's above the current price. It has no real value, right? You're buying to control something that you think is going to go up to 105. But right now it has no real value because it's not above that strike price of 105. In the money would be the opposite of that, right? Stock XYZ is trading for $100 a share, and you buy the $95 strike price. That's already in the money. It has real value. And this is true whether you're the buyer or the seller. That would still be considered in the money. Okay, so as you hear that repeated across all four of these trades, that will probably make more sense, and we'll talk through that in the example as well. But the buyer has control. So when you buy a call option, you have the right, but not the obligation, to exercise your option. But I wanted to put that in there. The buyer has control as a reminder. Now, the goal here when you buy a call option is to have the underlying move higher. The quicker, the better. It's a bullish bet, right? So if you want to buy a call option on stock XYZ, it's because you think stock XYZ is going to go up in value, and hopefully quickly, because we have a time frame here that is ticking away when we buy a call option. So again, more on that, but just a general guideline. Now, when you do this, like I said, we are long a contract because you bought it. And if you ever want to get out of this, as we'll see when we jump over to Fidelity, sell to close when you're ready to exit the position. And I put majority in there because a lot of option contracts, that's what it is. You jump into this contract, the price moves, right? Maybe you sell a contract that's out 5 weeks into the future, or you buy a contract out 5 weeks into the future. And stock XYZ over the first 5-day period goes from 100 to 115, right? There's this big move. You'll be able to sell that contract or close it out, right? Because you bought it and you want to sell it, you want to close it out for a big profit. You might just do that over a short period of time. So a lot of times, even though you're buying a 5-week contract or something like that, you might only be in that for a week or 2 weeks. Now, when you want to get out of that contract, we're going to sell to close when we're ready to exit the position. So we buy to open. When we're ready to close it, we sell that contract to close out our position, right? Or you have the option. You can allow this to expire naturally, or take assignment at the strike price, right? And take assignment at strike price. So we have a strike price, as we'll see, associated with this. If we wait this period out until we get to that expiration date, it's going to either expire because it's out of the money, worthless, or if it's in the money, it will be assigned to you based upon the strike price that you agreed to. So if that all makes sense, again, I'm going to review these. This one was a little bit more in depth, but as we jump over to Fidelity, we'll start pulling this information together with our trade. Now, once you have your options trading account set up with Fidelity, it's easy to access through the trade button. Once you click that, you should see a drop down where you can select options, and it'll bring up a box similar to this. So from here, you can place your trade. So we started with buying a call option, and that's what we're going to set up here first. So in this case, I'm going to use the underlying NVDA, which is NVIDIA, a popular stock trading at $110.93 currently. And you can see that I've got 100 shares of NVIDIA in this account. So if I want to do covered call strategies and things like that, I can with tier level 1 because I have 100 shares to sell against that position. But in this case, we're talking about buying a call. So from this setup, you can also see there's an option chain. So you can go to there if you want to look at your option Greeks. That's out of the scope of what we're talking about today, but that's where you would find that information. You can also do option summary, which will summarize all your different option trades that you currently have open. And you can view orders as well. Then you have all your different setups here as far as what you can do. So we're going to start with calls and puts. And again, you've got more strategies in here that you can go to, that you can reference, that'll kind of give you defaults. But for what we're doing, we're going to be doing simple one leg option trades. You can see where you can add a leg. If you wanted to get to fancy options, you can. You can just build out any kind of option trade that you would like to do that you have available with a tier that you're in. So in this case, because we are buying a call option, our action, just like discussed, is buy to open. Again, reference that cheat sheet if you want to. Quantity, I say 2 because I didn't want to use 1, but this means 2 contracts. So that's going to give me control of how many shares? 200 shares, right? So don't forget, 1 is 100 shares, 2, 200 shares. Now we are setting up a call option. We want to buy a call option. We're bullish on NVIDIA. We think it's undervalued. It's been mistreated. This thing's going back to its highs, 140, 150, wherever it topped out at recently. And I'm going May 16th. So today is 4/12. So this gives us a little over a month. So we would call this a monthly kind of option. And we have that May 16th date. And as you pull this open, one of the things that Fidelity does is they call out earnings, which is nice, so you can see where you're selling or buying. So I'm picking the May 16th. Okay, that's just arbitrary. Shorter dated options will cost you less. Longer dated options will cost you more. More time, more expensive. Strike price. What about strike price? How much will that affect the option trade? If we keep this steady and we can kind of play around with in the money, at the money, out of the money. And you can see the cost, right? So each one of these is going to cost between our bid and ask, which is $575 and $580. If I jump around a little bit here, I'm sorry, but just trying to think out loud. So let's say 100. What is 100? Is that in the money, at the money, out of the money? 100 would be in the money, and in the money call option, right? Because this already has value, because NVIDIA is already above this. So we have a bullish bet on this that it's going higher, but we're actually buying something all the way down at 100. So this is going to add in all that real value, okay, that $10.93. So it's going to cost us a lot more. So now these two contracts are up to almost $3,000, or about $1,500 per contract. So $1,495 or $1,500 times 100, right? 100 shares of the underlying gets you to about $1,500, right? Times 2. So that's an in the money. At the money would be right around 110. So at the money would be 110. That would cost us about $830 per contract. And a 115, kind of reaching for an out of the money contract, would cost us about $575. Okay. So that's that. You can see this is on the weekend. You're not going to see volume here. So we're not going to get too much into that. But volume is important. Volume and open interests are important with options as well. So you want to trade with popular stocks. I try to stay away from things you've never heard of. Don't use options. That's my recommendation. Use popular stocks and use popular ETFs, right? So if you want to trade options with QQQ or SPY, I've got information on my channel about that as well. Now, order type. The two that I tend to go to are market and limit. If you're new to options, that's where I would stay. Now, market's going to execute this per the market maker's rules between our bid and our ask price. So again, we are a buyer, so we're going to be playing closer to this ask price, the more expensive side, and the seller is going to get closer to this bid size. In between, this is a market maker, and they're going to make a little bit of money by making this transaction happen. So market or limit. Now, the smart thing to do here is to set a limit order and say, okay, I'm going to limit this to my price of 580. You could go midpoint too. But at 580, if this stock is moving around in the background, you're not going to get a price dramatically different than this, okay? So a smart setup here is to say limit 580, enforce till day. And once you apply this, just like anything, just like buying a stock, if you have a limit order and it doesn't execute, you can cancel that. You can go to your orders and cancel that right away. Margin, I have margin set up. If you don't have that set up, it'll be defaulted to cash. But if you have margin in your account, you can use margin. I don't access my margin, but it defaults to margin. Okay, so that's important to understand. I always have cash available for all my trades. You don't need to do that, but that's the way I do it. All right, so this is setting up a call option. Those are the instructions that you have, okay? So let's do a realistic trade here. Buy to open 2 call contracts May 16th. I think it's going to go up a lot over the next month. So I'm going to buy an out-of-the-money call, 115, and I'm going to pay about $1,161, okay? And again, I could go to market and be about the same. So now that we understand all that, what's going to happen over the next month or so? Well, our max gain shows as unlimited, meaning NVIDIA can go to $1,000 a share, $2,000 a share. We don't know, but the higher it goes, the more our gain will be. But we can't lose any more than we put into a call option that we're buying. So in this case, since we're spending about $1,160, that's the most we can lose. The worst thing that can happen is this goes to zero, has no real value at expiration, and we just let it expire worthless. We lose our $1,160. Okay, so that's the worst thing. The best thing that can happen is it goes up above our strike price by a lot. So how much can we make is the question, right? So let's say it goes up to $120. Did you make money? No, you didn't make money, because at 120 at expiration, because that's what we're studying here, you can close this out earlier too, but at expiration, this would have $5 of real value, allowing you to call away the shares at 115, even though they're worth 120, right? So you're going to call it away and it's going to have $5 of real value. 120 minus 115. And it gives you a control of 200 shares. So 500 times 2 equals 1,000. So if it goes to 120 at expiration and you close this out at expiration, or you take assignment and you immediately sell those shares, you would realize a gain of 1,000. But you spent $1,161 on it, so you actually lost $161. So that's why we get to our break-even number here. If we take 115 and we add what we're spending per contract to it, we get to 120.80, right? That's our break-even. 580 plus 115, not $5.80. $5.80 times 100 equals $580. Add that to it, and that gets you to your break-even of 120.80. So for us to make money at expiration, it needs to be above this. Now there is the scenario where we buy to open, and this is where I say a lot of these get closed out early. So we buy to open 2 call contracts, and NVIDIA takes off, and it goes to 115 on day 2 of this 30-day contract. In that case, you will make money on this if you go back and you sell to close these positions, because it went up so fast that the value will increase considerably over those 2 days. Okay, it would be like similar to this being at 110 right now. So this is 111.61. So if we took off $5 right now, you'd be able to close it out for about 16.81 in 2 days from now, right? So we make about $500. So you can close these out. You don't have to take them all the way to expiration. But that's the general idea behind buying a call option. We're long term. We're betting on this going up in value considerably. We're willing to spend a certain amount of money. We know that that's all that we can lose. And we can make profit if we get that move correctly, if it moves in the right direction quickly enough. And at the end of this, we'll actually execute some real trades, so you can see after you preview this order and place the order what that looks like within your account. And finally, let's talk briefly about your rights as the buyer of a call option. When you buy a call option or a put option, you have the right but not the obligation to exercise that option. And when somebody says exercise, that means you're going to call up your broker and say, I want my shares with this call option. I want to take possession of these shares now. It's above the strike price I sold, 110. Maybe it's at 115. I want those shares. In that case, they will exercise that option. They will put them in your account at that 110 strike price, even though it's worth 115. So that's where you make that money. You make the money from 110 to 115. But let's not forget, you paid for this right. You paid $1,681 for that. So how did you do on that option trade? Probably not very well, no matter what time it is between now and May 16th, because you made essentially $500 from 110 to 115 times 2 contracts, $1,000. How much did you pay for this option? $1,681. So you lost $681 by calling up your brokerage and taking assignment of those shares. Okay, so that's one thing you can do. Now, there are times when you want to do that, but typically, the vast majority of the time, the better option for you is to just sell your options. Okay, so you bought to open 2 contracts, goes up to 115. Maybe that move happens really quickly. By selling to close that position, you're going to collect that $5 of what we call real value, sometimes referred to as intrinsic value. That's the fancy word. And you're also going to collect the time value. That's the extrinsic value that you don't get if you exercise your option by calling the brokerage or taking assignment of those shares at expiration. So typically the better answer is to go click sell to close. And again, we have those examples at the end of this video. Sell to close out that position and collect the extrinsic and intrinsic value, the time value, and how much it is in the money. That's more money for you, and vastly, the majority of the time, that's going to result in a better trade for you. So always consider that if you're getting into this, make sure you understand your rights, but when do you want to exercise those rights? When you actually want to take assignment versus just closing out those shares. Option number 2, closing out that position, is typically the right answer. So now let's jump back over to our cheat sheet and look at our second trade. In this case, it's buying a put option. So our first trade was buying a call. Now we're buying a put. So a lot of the instructions will be similar, but we'll talk about the differences as we go through it. Our action is still buy to open. We're buying a contract. We're paying a premium because we are a buyer. We're paying it to the seller, or our victim in this case, right? Hopefully. So we are paying a premium to own this contract till expiration at the strike price that we decide to buy. We're using leverage just like before. We're paying a little bit to control 100 shares. So what's the difference, Dave? Well, the difference is with a call option, that gives you the right, but not the obligation to call away shares. I want those shares given to me, right? But a put option allows you to put shares to someone else. This stuff is terrible. I don't want it anymore. You take it at the strike price because I own this put contract. So we've talked about this before, but this concept of in the money and out of the money is important to understand. So in the money, better odds, more expensive. Out of the money, lower odds, less expensive. So let's set up an example here so we can have a better understanding. So stock XYZ trading at 100 shares. If I buy the $95 strike price with a put option, is that in the money or out of the money? It's below the current price, so it has no real value. So it's out of the money, right? It has low odds of actually occurring. And it doesn't cost me a whole lot because it's a reach, right? We're talking about stock XYZ, the greatest stock ever, and we think it's going to go below our strike price of 95 by expiration. The odds aren't great on that, but it doesn't cost me a whole lot. But what if I took the opposite side of this and I said, I want to buy an in-the-money put option. Stock XYZ is at 90 or at 100 right now. What if I buy the 105 put option? Well, that has real value right now. That's pretty good odds. I bet you, with it sitting at 100 right now, maybe it'll go even lower. That's my idea. It's got pretty good odds it's going to stay below 105. That's going to cost me more money. Okay, so it actually has real value because it's above the current price. Okay, so get that idea. It's the opposite of the call option. It's a put option. So in the money is below the strike price. Okay, so buyer has control of the shares again. Buyer has control of the option. So as the buyer, you have the right but not the obligation to exercise this put contract. That's your right. That's one of the things that you're doing when you pay a premium for this. So now the goal of this put contract is to have the underlying move lower, right? Quicker the better, right? It's a bearish bet. I think stock XYZ is going in the toilet. It's a terrible stock. It's going to go down. I'm going to buy a put option and make a bunch of money. Right, so, and when this is paired with a long position, this is insurance. That's a really good concept. I think this really ties it together really well. So imagine if you have 100 shares of stock XYZ and earnings are coming out. They look a little sketchy. You're not sure about what president is going to do with tariffs this week. So you decide to buy a put option. That will act as insurance with your position. So you own 100 shares. But as this stock goes lower, this put option will go up and up in value. So it ensures the position that you have. I often talk about it or compare it to like car insurance, right? So if you have a car and you're driving this car around and you wreck this car, it goes down in value, just like the stock would. But luckily you have a put option in place that will protect it. So again, as we look at it on Fidelity, it'll make more sense. So in this case, you are long a contract because you bought it. And if you wanted to get out of this, you would sell to close when ready to exit the position. Again, majority of the time, these are settled before expiration. So you buy this, you put it in place, and then you close it out if it's profitable. Or maybe you were wrong and you close it before for a few bucks, but a few bucks is better than zero. Or you allow it to expire in the money and put shares to the seller as the other option. Okay, again, we'll talk about that when we jump over to Fidelity. So back to Fidelity, and we're going to use NVIDIA again, and let's set this trade up. So in this case, we are buying to open a put contract. Again, NVIDIA is at 110.93, and I own 100 shares. So right now, this is 4/12 of 2025. So if you're watching this in a year, this might not make as much sense, but this is Trump tariff time. The markets are in turmoil. We're up a bunch one day, down a bunch the next day. Who knows what's going to happen this coming Monday? I don't, that's for sure. So maybe I want to use an option to protect my portfolio since I own 100 shares of NVIDIA. How much would it cost me to protect my portfolio? That's the thought process with buying a put. So in this case, I'm, again, buying to open is my action. I'm going to do one contract to cover my 100 shares, and I'm going to do this as a put option, and I'm going to give myself out till May 16th because that's the date we're using right now. Now, something that might make sense is for you to go, but earnings are coming up on May 28th. Maybe I want to protect my portfolio through that earnings date. So I'm going to make it May 30th. How much will that increase the cost of this put option? My guess is this is going to go up to $1,200 or $1,300 just because I'm adding 2 weeks and I'm going across to earnings. Let's see. And actually not too bad. $903. I thought that would actually be more of a dramatic increase. Well, let's just stay with May 16th for consistency. Now, if I wanted to fully protect my portfolio, I would have to do this close to at the money, and that would be a 110 strike price. So again, the higher I go, right, the more it will cost me. So if I wanted a 120, it's going to cost me $1,250. If I want a very inexpensive one that's maybe a $90 strike price, it's not going to cost me much, just $200. We're reaching, it's less likely to happen. Right, so let's go to at the money in this case. I want full protection on my automobile. I'm buying the best insurance out there at a 110 strike price. With all the volatility in the market right now, and it is pretty high, the VIX is very high, this will cost me about $720. That's my ask price, right? This is what the buyer has to pay. This is about what the seller would get. And we can do this at market. We could also set up a limit order like we discussed and set our limits and try to get that to happen. But a lot of times with tight bid and ask prices, and this is pretty tight, a market order is sufficient. So that's how we would set it up. $720.65 coming out of my account. Will I make money? How much can I make? What's my max gain? My max gain is $10,280. But is it really in this case? Not really, because I also own 100 shares. So I'm buying protection. Basically, I'm putting a stop loss in place in a sense at a 110 strike price. So let's think through this. If this particular option, if NVIDIA is the next Enron, if it goes to zero, then how much is this option going to be worth? It's going to be worth the full value from 110 down to zero, right? So 110 times 100 equals $11,000. But I also had to pay a premium up front of $720, giving me a max gain of $10,280 on the option. However, unfortunately, I also own shares, which would be now worth zero. So it would essentially be offsetting, just like full valued insurance, right? You run your car into a tree. Oh, that's terrible. But luckily, I have insurance, and they send you some money for the full value of that vehicle. Hopefully, if you've got good insurance. Now, what is my max loss? Well, the most I can be out of pocket when I'm a buyer of an option, whether it's a call or a put, is the premium that I'm paying, which is $720.65 in this case. So that's the most that I can lose, right, is my premium that I'm paying out. And then you see the NVIDIA break-even price. So what is the NVIDIA break-even price? Well, if you take that 110 and you subtract the premium that you're paying, you're going to get to that 102.80. Meaning I have insurance. I get to replace this at $110, but I'm paying $720. So let's think about it again at expiration, just like that call option that we were talking about. If at expiration on May 16th, NVIDIA has dropped down to, let's say, $100 even for simplicity. At 110, this would have $10 of real value or $1,000, right? We would make $1,000 on the option at expiration, either through the assignment process or closing it out at the last second, late on Friday, May 16th, prior to the close of the market. So let's say we close it out, we collect $1,000. Well, we have $1,000 in our pocket, but we spent $720. So we made about $280, right? We did pretty good. If it goes to 1,000 or 100 at expiration, we make $280. Now, if it goes all the way down to 90, then we make $2,000 minus $720. So now $1,280, right? So we're looking for a large move in this case, and that offers us insurance at any price that will offset the loss that we have from owning these shares. So that's the idea behind buying a put option. And it is important to understand as the owner of this put option exactly what your rights are as we get close to expiration. So you have two different options here. One is I get down to May 16th, close to the end of the day, maybe it's 3:30 p.m. NVIDIA's dropped to $100 a share. If you want to close out that option, remember you bought to open, now you'd want to sell to close, and it would be worth around $1,000, right? Because it's 10 points in the money. So you'd be able to sell it for $1,000 that you paid $720 for. So you'd make about $280 by doing that. And that is the option. The option is closed. It doesn't affect any of the shares that you own. However, if you choose option 2 and you just wait it out, when the market closes that day, the next day, the assignment process will occur. Okay, so In that case, you will lose your 100 shares of NVIDIA stock, in this case, that you had insured, right? And you will put those shares to somebody else at that 110 strike price. So you still paid $720 to have this option. That money is gone, but now you'll be credited $11,000 in your account, right? At 110 strike price times 100 shares, you'll see a credit of $11,000 in your account, even though NVIDIA is only worth $100 a share or $10,000. That's where that $1,000 comes from. Now, that's the insurance example. You don't have to own 100 shares. Maybe you just hate the stock, right? You don't own NVIDIA and you think it's overvalued. Look at that price to earnings multiple, whatever it is that you're looking at, and you say, this thing is worth, it's not worth 110, this thing's worth like 70. In that case, you don't own 100 shares, and you're just betting that this thing is going to decline. And that's how you can also play this. You don't have to treat it as insurance. You can just treat it as buying a put option that you think is going to go up in value because you think that stock is overvalued and it's going to go down in value by expiration. Okay, so that is buying a put option. Now let's flip over and start looking at the seller side. So now back to our cheat sheet for our third building block. And now we're jumping over to the other side of these trades and we're going to become a seller. So in this case, we're selling a put option or writing out a put contract. So before we were a buyer, now we are the seller. So our action is sell to open. And in our account, we would see -1 contract. We're short 1 contract. If we ever want to be made whole, we'd have to buy that back to close it out. And this is important. It says against cash you have on hand. So as a Fidelity Tier 1 option trader new to this, you're going to have the cash available in case these shares get put to you. Remember, we sold the right to the buyer. They have the right, but not the obligation to put shares to us. So what I'm talking about here is if, let's say stock XYZ and you sell a $95 put option and it drops down to 90, they have the right to put those shares to you at 95. If they do, you have to buy 100 shares. 95 times 100, 1 contract. That means you need to have $9,500 available to buy the 100 shares. So we call this a cash secured put. You want to have that money on hand. That's important. Now for doing this though, the cool thing is we get to collect a premium up front. So let's say when we sell this put option, the premium's $400, right? So that gets credited to our account, but that doesn't mean we made $400. And this is often overlooked by new people. The question is, will we keep it, right? So if this stock goes down in value really quickly, that could cost you $500, $600, $700, $800 to get out of. Let's say it goes to $700 and then you buy to close because you're ready to get out of this thing, right? You sold it for $400, you close it for $700, you have a $300 loss. So the question is, will you keep it? What will happen to the price of that stock during this period of time that you sold this? So typically, I say typically, we sell out of the money, so below the current price. Okay, so picture it this way. Stock XYZ is at 100. You want to collect a little extra money. You kind of like stock XYZ, so you sell a $95 put option, right? That's out of the money. It's below the current price. Just like the buyer of the put option, it's still below the price, so it's out of the money. And that's the typical setup, and that's what most people do, especially when they're getting started with options. Doesn't mean you can't sell in the money, and there are times you certainly would want to do that. But the general concept is buy at a lower price, right? So that's the idea. Now, the goal is to have the option stay above the sold call strike price by expiration. So we hope if we sell that $95 strike price that it stays above that. So I say slightly bullish trade. Like if you're going to sell a put option, you must think that this particular stock is going to go up in value a little bit or maintain its value. You definitely don't think it's going to go down a bunch or you wouldn't do this trade. In this case, we are short a contract, right? We sold it, so it'll say -1 in our account. If we want to get out of it, we would buy to close when ready to exit the position, or we could allow it to expire naturally. Like that can happen, right? It goes all the way to expiration and it stays above our strike price and it just expires. Or we could have shares put to us once it's in the money or at expiration. So if it does fall below our $95 strike price to 92, at expiration, these shares will get assigned to you. But you also have this right that we sold to the buyer, and they could say, I want to execute this trade. I want to take assignment. In this case, that means you would get 100 shares put to you randomly on a date. okay? And you don't know if that's going to happen, but it doesn't happen that often. Again, we'll talk more about that as we jump over to Fidelity. Back to Fidelity. Okay, so now it's time to become a seller of options. And if you were to say, what is your favorite of these 4 building blocks? I would say, if I could only pick one, I would become a seller of put options. And I've talked about that. I'll link some videos above and below for that information if you want to understand a little bit more about why. But I think all these building blocks are really extremely important. And I think if you ever find somebody that says only do this, then they probably don't have a really great understanding of options and how they can be utilized. So all 4 are great, but yeah, I often sell puts. So NVIDIA, again, is our guinea pig, 110.93. I own 100 shares. I'm selling to open in this case because I'm now a seller. We were buying to open, now we're selling to open. I just want to do one contract. I don't have that much money in cash right now, right? So I don't want to buy too many shares because that would cost me, $11,000 if I want to buy these shares. So I am giving up that right when I sell this put contract. So sell to open, one put contract. I'm going to give this about May 16th, right? I don't want to go across earnings because that could really upset the apple cart. I'm just going to go out till May 16th. And what's strike price? Well, I don't, I just trying to collect a little extra income, and I'm going to go all the way down to 95. So right now, if you wanted to sell to open one put contract, you would collect a premium for that $95 strike price of $273. That's pretty far out of the money, right? 15.93 points, almost 15% from the current price. Could you go lower? Yes. And again, we're in a period of extreme volatility right now with all the tariffs and things going on. So if you're looking at this at a later date, this might look a little wonky. These are good numbers right now. So it's a great time to be a seller of puts and seller of calls at this moment based upon volatility. But again, we're not getting into that too much. So let's say you wanted to generate $200 or so from this trade. The $90 strike price looks pretty darn good, almost 20% out of the money from where we sit right now. Okay, doesn't mean you have to sell out of the money. If you really want to generate a whole lot of money, you would go to at the money or even above it, right? So an in the money put option right now, meaning you think it's going to go up past 115 before expiration, would generate $954. That looks great, but that really changes up the numbers for you, right? So I think when you're getting started with put options, call options, especially from the seller side, you want to be out of the money. So I'm being conservative, and I might look at these numbers and see what kind of return this generates over the course of a year, doing this on a monthly basis. You might look at that. So anyway, sell to open one put contract, May 16th expiration, $90 strike price. If I execute this at market, I get around $200. So how does that shake out? What does that mean for the seller of a put option? Well, I'm giving away the right, but not the obligation to have these shares put to me, right? So I might have to buy 100 shares. So the first thing I have to understand that if it does go below 90 by expiration, it is likely to be assigned to me. Now, if it goes down to 88 by, let's say, next week, again, today is 4/12, so this is about a month away. Let's say in a week it goes to 85. Will it be assigned to me? I would say a very low probability that it's assigned to you at that point. So that often gets asked. It's more likely that it'll get assigned as it gets closer to the expiration date if it's in the money. And at that point, you might want to look at rolling out your option if you really don't want to take assignment of those shares. There's other things that we can do as well. And again, I'll have some real live examples at the end of this video that you can reference back to. So, selling one put contract May 16th, $90 strike price. It shows here the max gain. The max you can make on this trade is right around that 194, 198, right, with fees. Somewhere right between here and here as a seller. So let's say we collect this $198. In this case, let's say it's 194 because that's listed under max gain. So the 194 is if it stays above our strike price and goes all the way to expiration, expires worthless by staying above 90 at expiration, I would keep the premium that I collected, which is about $195 or so, right? Now, next one is max loss. What does this mean? I know it looks scary. Mine is $8,806. Well, you are on the hook for this. So I use the example of Enron, right? So if this is the Enron stock that goes to zero during this period in time, well, then you're on the hook for the full value of this, right? So at a $90 strike price, you'd have 100 shares put to you, but they're worth zero, right? So you'd have to pay $9,000, but you collected about $200, so you lost $8,806 altogether because it went to zero, right? So this is max loss of Nvidia crumbles to the floor during this period of time. Highly unlikely, but never say never. And then our break even on this sold put is 88.06. So if it drops to 88.06 at expiration, then we would break even because we are collecting about $200 for selling this option. So imagine it goes to 88 and the person says, ha, you have to take assignment. So you would own those shares at $88 a share. You'd have to pay 90, but you receive 200. So that math adds up to I break even at $88.06 at a share price of $88.06. Now let's talk about assignment on a sold put option. If this option goes below your strike price that you sold, you can be assigned those shares. So whether that happens at expiration or just prior to expiration, what does that mean? That means you're going to be buying 100 shares of Nvidia in this case at that $90 strike price. So even if it goes to $70, you're still on the hook for buying this at that $90 strike price. You keep the premium that you sold, but you're gonna have to spend $9,000 or 90 times 100 to buy those shares. So if you get assigned, you'll see a deduction in your account of $9,000, but you will receive those 100 shares. So that's the assignment process on a sold put option. So that's my example of selling a put option. If you have any questions on this strategy, please just ask me down below and I'll get back to you with a response. Now back to our cheat sheet for our final trade of the day, our final building block. In this case, selling a call option or writing a call contract. Just like selling a put, our action is sell to open. The difference is when we were selling a put contract, we were doing this against cash that we had on hand in case those shares got put to us. With a call contract, this is against shares you own, and this is often referred to as a covered call strategy. So I own 100 shares of stock XYZ, but I'm willing to part with these. I'm going to sell a call contract at a 110 strike price. If it goes up that much, I'm okay selling these. It's okay. That might be your attitude. Now, you do get to collect a premium up front, just like when we sold that put option. The question still is, will we keep it? So one good way to think about this is as two separate trades. I own the underlying, stock XYZ, but I'm also going to sell a call contract to collect a little bit of a premium. I can close this contract out after a period of a few days and keep maybe some of that premium. It's a separate trade, but I am giving away the right, but not the obligation to the buyer. So I could have these taken away from me if it goes in the money, right? So if it goes above that 110 example, they could take assignment of those shares, but it doesn't happen that often. So typically, just like with selling a put option, we sell out of the money. So in this case, above the current price. I'm willing to give up my shares of stock XYZ if it goes over $110 a share. It's only worth 100 right now. So if I get another 10%, maybe that feels all right, right? So that has to be the attitude. But you certainly don't have to do that. If you sell in the money, your premiums will look awesome. But again, it's more likely to happen. So typically when you're getting used to doing these types of trades, you're going to be selling out of the money to try to collect a little extra money with options. Now the goal here is to have the option stay below the sold call strike price by expiration. And it's a slightly bearish trade, right? Basically saying stock XYZ is looking pretty good. Maybe it's fully valued. So I'm going to sell this call option. All right. I don't think it's going to go up past 110. So I'll keep a little extra premium. Maybe I'll sell the 105, 104, 103. How bearish are you? How much do you think this is going to move? Is it going to stay below 100? Is it going to go even lower? Is it going to go to 95? Maybe I'll sell the $95 strike price because I'm really negative on this stock right now that I own for some news that's coming out, whatever it might be. In that case, you'll collect a really large premium, but your odds of it staying or going below 95 are pretty low, right? In that case, it would be an in-the-money call option. I have videos on that too. If you get more advanced, you can watch those. Anyway, you are short a contract because you sold that contract. If you ever want to get out of this, you would buy to close, right? You're short one contract. Now I want to buy to close that position when you're ready to exit the position. Or you could allow it to expire. If it stays below your strike price, maybe you sell that 110 strike price and it stays below there, and it goes all the way down to 90 over the next 30 days, and maybe it's so low you just don't care, you're going to wait until it goes to expiration and expires worthless. Or you could have shares called away once it's in the money or at expiration. So at expiration or during this period of time, if it goes above 110, they could call away your shares because you gave away that right. Or at expiration, it could get assigned, right? They could take away your shares at that 110 strike price that you agreed to. So that's that. Back to Fidelity. So now let's set up our example of selling a call option. So again, we're going to use NVIDIA. 110.93 is the current stock price. I own 100 shares. So because I own 100 shares, I can sell a call option as a tier 1 Fidelity option trader. So I'm going to sell to open one, not put, but a call option. Again, I'm going to use that same expiration date for consistency. This would generate a lot of money at that strike price that we sold that put at because it's really deep in the money. It's a deep in the money call. And it's a really cool strategy, but if you're brand new to this, it probably wouldn't make a lot of sense. So let's start with out of the money, so above the current price. So let's go up to something that we think we can keep these shares but collect a little bit of premium. What's the number for you? Let's go to 125. Okay, so 15 points above the current price, almost 15%. All right, and for that, I can generate a premium of $234 if I execute this at market. Again, you can use limit, use market, whatever works best for you. Limit prices, again, will be reflective of this bid and ask spread. But for simplicity, let's use market pricing, and that would generate about $234 for selling this call option, what we're going to call a covered call. Again, it's called a covered call because we have 100 shares. We've got those shares covered in our account, and we're selling a call option. So max gain, let's start there, $234. Where do they get that number from? Well, it's because if it expires below 125 by expiration, if it stays below this price, I keep that full premium. That's my max gain. I can't make any more than that. But if it stays below the strike price, then I'm going to keep all that money, right? So I get a credit up front, and hopefully I get to keep all that credit. This expires at 0, and I don't have to pay anything to close it. But I can go buy to close, and again, we'll look at examples of that. Now, the max loss is unlimited, and that scares some people. Whenever they see that, they go, oh my God, what does that mean, Dave? That means that NVIDIA has no roof that it can't go through, right? It can go to $1,000, $2,000, $10,000 a share, but it probably won't. But that means in that case that you lost a lot on this option, right? The option value has an unlimited price that it can go to. That's all. So we'll put some real numbers around this before we leave this screen. And then the break even shows NVIDIA at 127.34. So how do we get to that number? Well, this is our break even at expiration. So we sold the $125 strike price, and we gave up our right. And for doing that, we get to collect a premium. That premium is $234, or $2.34 per share. So if I take 125 plus $2.34, I get to 127.34. So just for a second, let's forget about the 100 shares that we have. Let's just think about it from the option perspective, right? They're paying us $234 up front. At expiration, what would the value of this option be if NVIDIA was at 127.34? Well, it would be $2.34 above the strike price, meaning it would have a value in real world terms of $2.34. That would offset our gain. So we sell to open, we collect $234. Right at expiration, if it was at 127.34 and we wanted to buy to close that position, it would cost us about $234, and we would have no gain, we would have no loss on the option itself. But we do have 100 shares in this case, so we would have the gain all the way up to 127.34 from the option, from the shares themselves. So that's that break even number here. So now let's talk about like a real world scenario here, a couple of different things that could happen. We're selling to open one call contract May 16th. Let's say we're moving through this, and 2 weeks into this trade, I don't know, let's say NVIDIA goes to $80 a share. It drops significantly. What's the value of this option? The value of this option would be $20, $30, something like that. You collected $234. Maybe you can buy to close. It would cost you $34. You walk away, you buy to close, you keep $200. 2 weeks into this one monthly option trade, right? That could happen. What about if it just trades sideways? Time ticks away. As time ticks away, if it continues to stay around 110.93, every day that we get closer to this expiration date, the value of this option goes down. So you can see that, right? You can see this one cost me $234, but if a week ticks away, like May 9th, then it's worth what? it's worth 178, right? So a week ticks away, it stays at the same price, you still make money, right? So let's go back to May 16th, 234 still. So if it trades sideways, as time ticks away as a seller, you get that benefit, right? Time ticking away is a good thing for you. Now, the other thing that could happen is this thing takes off, right? It goes to the roof. Let's say it goes to, I don't know, 140. And let's think about it as an at expiration. At 140, it'll be 15 points above the current price, right? On 100 shares, that would be $1,500. Okay, so in that case, you sell to open this, you collect $234, but at 140, you have to pay $1,500 to close it, right? So you lose quite a bit. You lose about $1,260. So in that case, when you went to buy to close near expiration, if you wanted to keep your shares, you would buy to close and you have to pay a lot of money, right? You would lose out on that side. But you still retain your shares, so you have the gain in the shares themselves up to the strike price. That's one of the things when we talk about covered calls, that concept, right? We are capping our upside at the strike price that we sell. So typically when we're getting to understand options, it's a good idea to sell out of the money. So you understand that I'm collecting a little bit and I get to have the gain in the stock up to this point. But after that, I cap my upside with this call option. So that's an idea, and that's kind of how it can play out with a call option. Also, with a sold call option, you do have the risk of assignment. Again, you sold that right, but now the obligation to the buyer. So if this does go in the money, meaning above the strike price that you sold prior to expiration or at expiration, and you go through the assignment process, then the shares that you own will be stripped away from you at the strike price that you agreed to. So you will sell your 100 shares at the strike price. So with a 125 strike price, you will sell 100 shares, but you'll get credit for $12,500 in your account. So even if it goes up to 150, 160, you don't get $16,000, you get $12,500. So if assignment occurs, the risk here, and you let that occur and you don't close out your option and assignment occurs, that's what will happen. You'll get the credit for the $12,500 despite the value of NVIDIA, but it has to be above that strike price. Again, any questions on this, please post them down below. So now I would like to show you some actual real trades. Walk through, click the buttons, because I know that's where a lot of the fear lies, making mistakes during this process and not doing what you intended to do. So show you some of the areas that you might slip up on and what to look for. So this is the options trading platform here at Fidelity. And once you have that trade set up, you're going to want to select trade and then options, right? And then you want to pick your underlying. In this case, I'm using IBIT. It doesn't matter what you're doing. For our example, I'm using IBIT because I actually want to sell some call options with IBIT today. But this could be Alphabet, right? This could be Microsoft. This could be NVIDIA. This could be Pfizer, whatever it is that you're trying to trade against. I'm using IBIT because, well, it sets up well for what I'm trying to do right now. This number right here, 46.67, is the current price, but this is not dynamic. It's static. So behind the scenes, as we talk through this, the price is changing. So we want to make sure we get fresh information at some point. If we were going to let's say we wanted to buy calls, the setup would be buy to open. That's not what I'm going to do, but I'm going to show you that we're just doing the flip side of this transaction when we sell to open calls, right? So in this case, I'm buying to open 3 call contracts. So I'm long 3 contracts. I picked a May 16th expiration because that's what I'm selling right now. And I'm picking a strike price of 54. That's about 15% above the current price. Okay, so in this case, I'd be buying calls 15% out of the money. And that would be the setup if I was a real big believer in IBIT. I really felt like it was going to catapult over the next few weeks out until May 16th, and I could make a lot of money, right? That's the idea. That's the setup if I'm buying calls, because it only costs me $108 per contract to do that. So, for example, if I set this to a market order and I went to preview the order, this would cost me about $350 to do this trade and own these 3 contracts with the possibility of IBIT, right, increasing in value quickly so that I can make a profit. Okay. But in this case, I own IBIT already. I own a lot of shares of IBIT, and I want to sell to open. So I'm going to flip to the other side. You're going to see this, instead of it costing me this much, I'm going to take in a credit of that much up front. Okay, so We're going to, instead of buying to open and having 3 contracts that we own, we are going to sell to open, and we are going to be short 3 contracts. Okay, so if we ever wanted to make whole, we would buy to close those out at a later date. So I'm selling to open 3 call contracts, May 16th expiration at a $54 strike price. And each one of these is going to get me somewhere between $108 and $110. We talked about that in the other example. So this is more about executing a covered call strategy. I own the shares. I'm selling to open the right to the buyer, right? They have the right but not the obligation, as we talked about. And I'm going to do this as a market order, and it's going to put $324 of credit into my account. We'll decide later if that's a good thing or a bad thing, right? Will it cost me more to close these out at a later date, or I keep that money? But you could also set this up as a limit order and say, I'm not so sure about this. I want to make sure I get at least $1.08, and I'm not going to worry about it too much. So I want to set my limit order for that bid price to make sure I get at least that. Okay. But for some simplicity today, I'm just going to do it as a market order. Then you're going to come over here. Once you feel comfortable with your trade, you're going to hit preview order, and that's going to bring up your next screen, and then you'll place your order. So again, that's changed a lot. Now it's up to 47.01. So I'm going to go back. I'm going to get fresh data. I'm going to say edit order. I'm going to go back. I'm going to see what it says now as far as market order. Ooh, it's up to $1.15. All right, that's good. So now it'll execute at market at 47.01. Preview that order. And I'm ready. It's up to 47.04. It continues to climb. I might even get more because I'm doing it market here. Right? And I execute that, and it says filled at $1.16. Okay, so it went all the way up to $1.16. Stock market's a little crazy right now with all these tariffs. Everything's moving around very quickly. And with iBit, that moves around really quickly too. We're talking about Bitcoin in this case. So there you see it. It's been executed. And now we can jump over and take a look at it in my portfolio, so you can kind of see a live view of where it sits right now. And if we jump over to our activity and order screen, you're going to see the execution of that trade, the 3 contracts that we sold to open, and the credit that we received for that, $345.96, again, filled at that $1.16 price when we sold it. And in my account, along with all the stocks and ETFs that I own, you're going to see these call options, these put options that you've sold or that you've purchased. It will all be listed there. So in this case, I've got my iBit $54 call that I just sold. And you can see my cost basis, what I received, and current pricing. So since I just sold this a minute or two ago, you can see that the price has changed just a little bit. It continues to move towards my strike price. So you can see that on the option, I've lost just a little bit. So if I wanted to, instead of waiting 35 days until expiration, if I wanted to get out of this right now, you have the right to close these out. You would simply hit buy to close. And again, I'll show you this when we roll an option here in a minute, but you would buy to close and you would pay the current price to close that out. And again, right now it'd be just a little bit more than we received. So if I went, oops, I made a mistake. I didn't mean to sell and be short 3 contracts. I wanted to be long. Believe me, it'll happen at some point probably if you start trading lots of options. But if you decided you wanted to buy to close out these 3 that you sold, and you wanted to do that, you'd hit buy to close and you go through the exact same process, but you would undo what you just did. So you'd buy 3 contracts to close out these 3 contracts. And right now, it looks like it would cost around $5 more than what you sold it for. So around $3.50, maybe just a little bit more than that. So you would lose $5 or $6 for the oops transaction. So that is the buy to close. Now, if you like this transaction and it continues to go higher and you want to sell more, you would say sell to open. It would pull up the same data and allow you to sell more contracts at whatever the current price is. So again, you would get a little bit more now because it's gone up in value for that contract. Meaning when you did it, it was $1.16, $1.15. Now it's worth $1.17. So if you sold more, you get just a little bit more for those. And then the next thing is a roll, right? And that's what we're going to show you next. So for example purposes only, let's run through rolling an option. In this case, I've got an iBit $49 call. I've squeezed everything out of this, right? So I've collected 99.1% of the premium. So when I sold this, I sold it for $670. Again, this was 3 contracts that I sold, And if I wanted to buy to close them right now, it would cost me around $6. That's the current value. So rolling an option is essentially closing out your old option, right? It's buying to close and then selling to open, but you're doing it all in one step. So when I click this roll button, it's going to pull up this contract, these three, but it's going to be in the buy to close, okay? It's going to allow me to buy to close these and then open up a new contract, or essentially sell to open a new contract against these three with a new expiration and my new strike price. Some people think this is magic. It's certainly not magic. It just is closing out your old contract. Did you win or lose? That depends on how you sold it and what you collected. And then you're opening up a new contract, and that's when it's going to be based upon the new data that you've had. So we're closing out our old one, rolling to a new strike price, new expiration date. So I'm going to click this and show you exactly what that looks like. Now I'm rolling this option, and I'm only doing it to illustrate on this channel exactly how to do it. Would I do this if I was trying to make maximum profit? No, I would probably allow this to expire this evening because today is April 11th. That's why it's not worth much at all, right? Because we're sitting at 47.09 and this is a $49 call. So it's unlikely that this will expire in the money. I mean, it's below the strike price. So I would probably just leave this alone. It would expire and it wouldn't cost me anything. And I would just sell to open my new contracts. But for illustration purposes, we're going to roll this. So when I click that roll button, Fidelity is going to pull up all that information. It's going to say, okay, so you sold three. Now we want to buy to close out those contracts. So we're buying three contracts. Okay, buy to close three, the ones that we did, the expiration that was on there, which is today, at the strike price that was on that contract. It's going to cost me between $1 and $2. Yes, it says 0.01 times 100, that's $1 or $2. So it's going to cost very little for me to close these out. And then I'm going to sell my new contract. So in this case, I'm going to sell to open three. The question is, what strike price do I want to sell those contracts at? So again, I'm working at rolling out my positions right now with IBIT. So again, that's why we're seeing examples of IBIT, but whatever you're trading against, that's up to you. In this case, I'm going with the May 16th expiration, like I've talked about, and I'm going to pick a strike price. Okay, so completely flexible and up to you whether you're going to take in credit. So sometimes what happens from a roll is this price is well above this price, and we're trying to cover up our mistake when we close this out that we lost money. We're trying to cover it up by selling out to a longer expiration with maybe a different strike price in order to take in credit overall. In this case, I have a lot of flexibility because it really isn't costing me anything to close this out. So I really have a lot of flexibility. So let's say I want to go to the $51 strike price. I would be able to take in about $191 from each contract minus the dollar that it's costing me. Okay, so it's highlighting my bid and my ask. So worst case versus worst case, right? So it might cost me up to $2. I might only collect up to $1.91. Down here at the bottom, it shows me the net credit that I'm taking in. If it was a debit, it would automatically default to debit. And then the net amount that you're looking for. So do I want the bid, the midpoint, or the ask? I want as much as possible, but I know that there's a middleman out there, right? A market maker, an options market maker. So I'm going to get somewhere close to this bid and this midpoint. Okay, so $1.90 might be good. I'm just going to go with $1.89. That's going to give me $563 of credit for this $51 strike price that I have highlighted currently. So if I go to preview order, again, we've been talking for a while, so let's see what that price has changed to. 47.12. Okay, so edit, go back here. Okay, so now I get $1.89 net credit. Okay, still the same. Preview order, 47.14. Place order, and we're off and rocking. All right, so then we can take a look and see how we did with that particular order. And now I can verify my trades looking at my transaction history here at Fidelity. So first you're going to see that I bought the closing transaction for my existing three short calls, right? So I bought three to offset this and close it out for today's date at a $49 strike price. And that cost me $3.09. I had to pay that much to close out those existing contracts. But at the same time, I rolled to a new strike price, a new expiration, and that's what you see above here. So I lost $3.09, but then I opened up a new position and I took in a credit of $567.94 for my new sold calls at a strike price of 51 going out till May 16th, 2025. Again, today is April 11th, so about 5 weeks out into the future. So that is how a roll transaction occurs in the case of a covered call. So I'm buying to close my old contract, selling to open a new contract at a new strike price, new expiration. Whoosh. Okay, now that was a long video. So if that helped you out, please like and subscribe. But yeah, the world of options is quite vast. You could talk about it. I could talk about it for a very long period of time and probably still feel like I'm leaving a lot of things out. So what did we not cover? And by the way, if you're looking for specific information, I have many videos on options, and you can find that in my option playlist that I will link down below. So check those out if you want more information. So if you want more basics, you're going to find those there. If you want some more advanced information, you'll find them there as well. So other topics just come to mind. How about picking the right underlying stocks or ETFs? How do you pick that, Dave? What do you do? Well, I would say my only guidance here for newbies would be that you stick with high volume stocks. So I think I mentioned volume and open interest when we're talking about options. Typically, high volume stocks that trade lots of shares also have high volume on the options side and open interest. But when I talk about open interest, that's open interest contracts that are open at individual expiration dates and strike prices. If you can see lots of volume, that's going to make it very easy for you to open and close trades because your bid and ask spreads are going to be tighter. If you ever see something that says, yeah, $1 to $3, that's not tight, right? That's too loose, and you probably want to stay away from those types of transactions when you're first getting into options. So stick with stocks that you've heard about that are popular, well known, and that's probably going to help you when you're getting started. How about picking expiration dates? And that one's kind of tough. What's your trading? How do you like to trade? Do you like to trade dailies? Lots of people that really love these 0 DTE options, but I'm not a big fan. I like to go out to about that 4 to 6 week period. Sometimes I'll trade leaps. Those are like year-long option trades. So there's lots of ways to pick that, but I think the important thing to understand is that if you have stocks, ETFs that you like, you can go out. Typically, they're going to trade weekly, so every Friday expiration. But you're also going to find that they have daily expirations, like with the indexes, SPY or QQQ as well, like large ETFs. And you're going to find some that only trade on a monthly basis. So again, the volume is really important with these types of trades. So check all that out. And again, if you have any questions on any of this, please ask down below. I'm happy to help you out. If you like this type of content, like and subscribe, and we'll talk to you soon. Have a great one. See you.